Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlett Fu is on assignment once again. She'll be back next week. But let's get to the biggest stories right now in the nearly $22 trillion global ETF industry. U.S. stocks being kept afloat this Monday thanks to tech and energy names, with the main software ETF sitting at its highest level since January. Now, in just a moment, we speak with Hamilton Reiner. He is the head of U.S. equity derivatives over at JPMorgan Asset Management. And later on in the show, we're going to speak with Corey Hoffstein of Newfound Research to drill down into one of his return-stacked ETFs. But all of that and more coming up. As always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. Eric, what do you got?
Katie, guess what? Nobody sold in May, okay? To say the least. May was $191 billion into ETFs, the second or tied for the second best month ever. So that sell in May thing, obviously, we actually looked at the numbers. It would be ridiculous to do it anyway. But if you look at here, IVV, this is a BlackRock model, so you're going to discount this for a minute. They put a ton of money into IVV. VU, always on the list. More on VU in a minute. It's about to hit a big milestone. And SPY. So look, you've got what I call the three amigos up here, the S&P 500 ETFs, traders and retail, all interested. Then you got small caps as icing on the cake, and then the tech-ridden Qs, which is up here at $3.4 billion. It couldn't get more bullish in terms of the week and the month of May. Let's look at the outflows. There's going to be some money coming out of, I believe, it's the quality ETF. Yes, this is an internal BlackRock model, but it all offsets. They're just moving from one ETF to the other. But for them to move out of quality into IVV tells you they are feeling a little more frisky about the market. And then you hear of money out. These are all iShares. And then Soxel. We're going to go in this show, but this is 3X semis. Money came out of this, went into the negative 3X. More on that later in the show. Let's look at VU, though, right now. I want to hone in on VU, which is, again, I would say it's in permanent beast mode. It had $660 billion a year ago, Katie. Now it is flirting with $1 trillion. I mean, look how close that yellow line is. It's a couple pixels away from hitting the trillion. So could be tomorrow, could be in a couple days. And here's IVV and SPY. So again, I call these the three amigos, but there is a fourth, not big enough to be in the club yet. But you add this up, these four S&P 500 ETFs are 17% of the assets. So even when we talk about the hot sauce and some of the newfangled stuff, most of the money goes to this cheap beta S&P 500 ETFs, Katie, with VU leading the way.
So three amigos and maybe a little buddy on the side. Eric, thank you. Some quick breaking news here. I do want to mention, according to a redhead right now, that Anthropic has confidentially submitted a draft S1 to the SEC for an IPO. Let me read that once again, that Anthropic, we're learning, has confidentially submitted its draft S1 to the SEC. Of course, we've been tracking SpaceX, the potential for that mega IPO to hit in mid-June. And of course, it's been the big three that we've been watching there, another three amigos, when it comes to SpaceX, Anthropic, and OpenAI. It looks like Anthropic may be lining up here.
Yeah. This is, you know, it makes sense. Why wouldn't you IPO now? Everything is like really big and frothy, and this is perfect timing. Makes sense. This is going to be one of the most fascinating couple months for indexes. Our world is, there's the little ones that track it, but there's also these big indexes are going to be potential buyers quickly. Yeah. It's not going to take a longer. So these have a market ready to go when they IPO.
Absolutely. It's going to be absolutely fascinating. And as we mentioned, SpaceX, we're watching. That's expected in the next couple of weeks. But now we're learning that Anthropic has confidentially submitted its draft S1 to the SEC for an IPO. Let's get a little bit more detail now from Ed Ludlow. He is the co-host of Bloomberg Tech. He joins us now. So, Ed, we had been waiting for this one, and now we're getting a little bit of detail when it comes to Anthropic's IPO plans.
We've been waiting for this one. Did we think it was going to come literally the Monday after they closed a mega private round? No. I mean, this is like procedural, right? It's a confidential filing. We don't know the number of shares being offered. We don't know the price range. But this is a company that was valued on a post-money basis at $965 billion last week. In a round that was joint-led by Altimeter, Dragoneer, Sequoia, et cetera, and included backing from the hyperscalers. And, you know, it was an open-ended question. I think you guys were just talking about just then. How much does the SpaceX IPO either suck the oxygen out of the room, because you think of the commonality of the types of crossover funds that would need to support IPOs of this scale, or why not just go public? You know, maybe we can get into where Anthropic stands against OpenAI.
Yeah.
But it's not just a 3-line race to go public. It's a 3-line race for the market, which is basically enterprise AI software.
Well, let's go exactly there, Ed, because we've been talking about this race among these big AI companies to go public. SpaceX, of course, in a couple of weeks, Anthropic submitting their draft F1 confidentially here. Where does this stack up with OpenAI factored in as well?
Yeah, I mean, just prior to the red headline that just hit the Bloomberg terminal, the working assumption based on the reporting was SpaceX will price and list in the next 2 weeks, by the end of June at least. Then it was looking like OpenAI could also file confidentially imminently. It never happened, but look at September to go public. And we had previously reported that Anthropic was looking at October to go public. So there is some modeling and math to be done on when those can happen mechanically. But the big number that came out of Anthropic's round last week was revenue run rate at $47 billion. And a lot of the narrative has been Anthropic kind of accelerating beyond OpenAI in terms of its financial performance and the traction that its underlying models and coding products are getting with the world at large. The interesting bit that's changed now is that Anthropic and OpenAI have had time to read SpaceX's S1 and look at what SpaceX is basically saying for its TAM number and how it sees its future in the world. And they've basically, according to the confidential filing, said, you know what, this provides an interesting environment for us to also go public.
Absolutely. Well, Ed, really appreciate your quick insight and reporting here. That is Bloomberg's Ed Ludlow joining us on the news that Anthropic has confidentially submitted a draft IPO filing to the SEC. This gives Anthropic, of course, the option to go public after the SEC reviews this. The number of shares to be offered has not yet been set, nor has the price range for those shares not yet determined. We're going to continue to follow that news as we get more details on that confidential draft IPO filing from Anthropic. But let's get back to ETFs, because sitting to my left, I'm pleased to say, is Hamilton Reiner. He's head of U.S. equity derivatives over at JPMorgan Asset Management. Hamilton, great to see you in person.
Good to see you. I'm not sure how I could follow that Anthropic piece, Katie, so thank you for the slot.
Yeah, instead of a segue, I'm just going to jump right into the weeds here because, of course, I want to talk about JEPI. I want to talk about JEPQ, household names, at least among the households represented here. And it's interesting. I mean, you think about what you're doing, premium income. Increasingly, it's being mentioned in the same breath as buffer ETFs. And I want to hear from you, how those two categories are differentiated. What is the pitch for premium income, what you're doing over at JPMorgan versus, say, a buffer strategy?
So the first thing I'd say is the biggest challenge we all have is that we're at unprecedented levels of cash in individuals' portfolios, and excess cash is just the enemy. We're at like 70-year highs. So that's the first thing. And getting that cash to work is one of the most important things any of us could do. And when I think about a premium income strategy, it's designed to give you three things. It's designed to give you dividends and options premium, some of the upside, and less risk and beta in the overall market. The underlying index may be the S&P, maybe the NASDAQ. We have some global products. That's the first thing when it comes to premium income. But one of the things I would highlight is less risk, less volatility, less beta. Now, with a buffered strategy, it's much more of a, let's call it, strategy that gives you equity market exposure, but with guardrails or protection. And we have something that's similar in our Hello strategy, because what we do is we actually create 3 different hedge windows. But one of them is about giving you income as a big chunk of your total return, premium income. The other one is about giving you the equities with some downside protection in place. So they both can fit into your portfolio with that more defensive nature, but one's designed to give you income, the other one's designed to give you, let's call it, the guardrails around equities.
Right, fair point there. And I mean, to that point, you think about buffer ETFs, they're often mentioned, as bond alternatives, and that's something that Bloomberg Intelligence has done a lot of work on as well. What about premium income? I mean, is that something that also fits into that broader category, or is this truly equity exposure?
So I'm not sure I would call buffereds or a hedge equity product a bond alternative. I'd say that it's designed to provide one of the features that bonds does, which is downside protection. As you know, bonds don't always zig when equities zag, and a buffer strategy or a hedge equity strategy will. What's really nice about a premium income strategy is it does give you the income that in many cases people associate with fixed income. And it does it with less risk and less volatility and less beta in the equity market. It also does it without duration risk and without credit spread risk. So a premium income strategy is not meant to replace your fixed income. It's meant to replace a portion of your equity and a portion of your fixed income, giving you a better total return from a portfolio construction perspective.
So sometimes when these covered call ETFs are brought up, Matt Tuttle, who is obviously an ETF issuer also, he had an interesting point. He said capping upside while retaining full downside exposure is the wrong way to do this. After a sell-off, you give away the recovery precisely when you need it most. Put credit spreads, collect a similar premium, but without that issue. What do you think of that? Like in terms of the downside, that income gives you a little, but maybe not all, and how much can you catch of the upside when it comes back?
So a couple of things I would say. If you lose less when the market sells off, you don't need to make as much money when the market goes up. If you look back to 2022, JPY was actually down only 3.5 when the market was down 18. So you didn't need to make as much back in 23 and 24. And then just in the first quarter, a strategy like JPY was actually up with the market down. And so I'm not sure if it's as simple as saying it's the index that's capped to the upside and not giving any downside protection. Being JPMorgan, we're an active shop, so the active stock selection plus the options premium helps us lose less of the downside. And so when I think about credit or credit spreads, there's nothing wrong with credit. I happen to like credit, but the problem is you expose yourself to spreads. In addition, you're probably not going to make more than the yield. These strategies give you not just the options premium, they give you some of the upside. And I think sometimes that's lost on people. Now, there are some strategies, and you've talked about them quite a bit, Eric, this idea that you can have 20, 30, 40%. And in those cases, you probably are mortgaging a little bit of your future to get that premium today. But with something that's more modest, like JEPI 7 to 9 or JEPQ 9 to 11 through a cycle, you're actually getting a three-pronged approach to total return. Some dividends, some options premium, and some of the upside. And most importantly, less risk. To look at this relative to the index, it's just not apples to apples. We don't use leverage. We don't believe in leverage. And so I'm not sure that's the apples to apples comparison. You have to think about it on a risk-adjusted basis.
So I always thought JEPI really made its mark in 2022. This is a rough year for the markets. But since then, the markets have gone up. And they go up and up and up. And it's like defying gravity all the time. Now, you just heard about these IPOs coming out. They're going to give the market probably another kick. You don't do any of that. Now, you're trying to offer something that's a little more conservative. How much harder is it to try to sell something like this strategy in a market where it's getting frothier and frothier with AI?
So one of the things that we share with investors is we talk about what to expect. And I think that's something unique from our lens. We don't lead with an income level. We don't lead with a return perspective. We lead with the people, the process, and the philosophy. And so with a strategy like JEPI, let's use a name like NVIDIA. When you get exposure to any of the large indices, you get anywhere from 8 to 14% in NVIDIA. We're going to be very different intentionally in JEPI, that we're going to cap every name. We're going to cap every sector. And by doing that, you're starting off with something that looks a lot different than all of those indices that have great exposures. And so do I think it's hard? I think it's all hard. But at the same time, people are talking with their pocketbooks and wallets. And JEPI and JEPQ in the derivative income category I think are 1 and 2 year to date. So they're kind of understanding what to expect from these strategies.
And I do want to talk about, some of the knockoff, the copycats that JEPI has inspired. One of them comes from Goldman. The ticker there is GPIX. It's the Goldman Sachs S&P 500 Premium Income ETF. It launched in late 2023. You take a look at total returns, JEPI versus GPIX, and GPIX has meaningfully pulled away. You see a similar dynamic when it comes to their NASDAQ 100 Premium Income versus JEPQ as well. And I wonder, how much you're paying attention to that? How do you explain that sort of differential, and how do you close that gap?
So a couple things I would say. There's nothing else like JEPI in the industry. That point, that 35 to 40% less risk embedded in the market, I'm not sure that the Goldman strategy that you mentioned is actually a comparable. But I'm absolutely looking at the entire landscape. And I think the entire landscape, I think it was BlackRock or somebody else said the landscape can go 2 or 3 or 4x what it is today. And I don't doubt that. When you think about the aging of Americans, when you think about where these strategies fit into portfolios, there's still a lot of room to grow. I look at the entire categories, but it's a good time for me also to bring up Rocky and ROCQ, where they're a lot more like some of the other more benchmark-aware strategies, where Rocky is going to look a lot more like the S&P 500 with an options overlay. We're doing something a little unique there as far as doing it as a call spread. So if you have a ripping market, we'll reparticipate with 100% above a certain point. and ROCU, which is on the NASDAQ 100. And the two of those strategies, they're just over 2 months in duration. I think they're over 550 million already. So they're really getting a lot of traction as people want perhaps a different flavor from JPMorgan.
Absolutely. Well, Hamilton, it's great to get some time with you. Really appreciate you coming into studio with us. That is Hamilton Reiner of JPMorgan Asset Management. We do want to get back to that breaking news that we got at the top of the hour, that Anthropic has filed confidentially for an IPO with the SEC. This is a draft S1, again, confidential, but let's get a little bit more detail now with Bloomberg's Anthony Hughes. He's an IPO reporter for us, as well as James Seyffert of Bloomberg Intelligence, who covers ETFs. And Anthony, I'll start with you on this Anthropic news because, again, we're talking about confidential draft paperwork for their IPO. So we don't have many details beyond that, but tell us what we know so far.
Yeah, typically when we get to this stage of confidential filing, there's not a heap of extra information, but sometimes this filing, which it will be in at the SEC, will have a fair bit of detail worked out, including the banking syndicate. Sometimes they're not that far down the track, and you can file without the banking syndicate, for instance, but which is actually what SpaceX did in March. But really, what this does indicate is that with all the recent news around Anthropic, which has obviously been very positive for their valuation, getting up and around $1 trillion, it's really time for them to go. And I think it's a bit of a race at the moment in terms of the AI companies. And really, the thing about this filing, it really tells you that they're probably looking at a post-Labor Day listing, because Anthropic will be such a hotly sought IPO that they'll probably be able to go through this process in a way that's, there's not going to probably be a lot of delays, apart from the fact that they'll be getting SEC review and the SEC might be giving them a bit of back and forth and questions. But basically, this process is going to be as rapid as it gets.
One of the things we've been hearing with these IPOs, SpaceX, Anthropic, and OpenAI, which we've all diagrammed, so these passive indexes are going to have to buy a lot of these stocks. People are like, oh, they're the exit liquidity. How much of that is factored into this IPO, and how big would Anthropic be relative to, say, SpaceX?
Well, I think obviously Anthropic's valuation is going up substantially over time, and a lot will depend on the environment in the market at the time in terms of how people are thinking about AI. I mean, obviously there's a lot of debate at the moment about whether AI stocks are expensive or cheap, and it's a pretty vigorous debate, isn't it, at the moment? So, I mean, obviously at the moment this is a great time for Anthropic to go public, given some of the valuations we're seeing, not of AI adjacent companies and a whole bunch of names in this area. But in terms of the index discussion, I think the index providers have decided that it's appropriate for companies that are very large private companies, that they should be represented relatively quickly into the index, because if that's not the case, then maybe those indexes are not very representative of the market that it is. And obviously SpaceX we're talking about a $2 trillion valuation and $1 trillion in the case of Anthropic, and we've got OpenAI perhaps $1 trillion. These are obviously going to be very large investments, and if people don't have them if they're not represented in index funds, then those index funds are not really representing the market. So they are making somewhat of the special treatment for these companies, but on one level it's justified. On another level, it's helping to create a lot of demand for this stock, which could help smooth out the aftermarket performance.
Well, James, let's talk a little bit about that, because, the addition of SpaceX, that fast track into a lot of these indexes, has caused a lot of controversy. And that's where a lot of the conversation has been around SpaceX specifically. But how would Anthropic factor into that conversation as well, were it to go public in the next few months?
Yeah, so it all depends on how much actually comes out in that IPO, what the float is. SpaceX is targeting around $75 billion. And if right now the most recent valuation that you're hearing is around $1.8 trillion, so we're talking less than 5% of the float. General assumptions for Anthropic and OpenAI, people are generally assuming it will also only be 5% of the float, maybe 10% at the high end. So that will determine how much buying there is. But no matter how you slice it, the way that these indexes are set up, Russell specifically in the NASDAQ 100, assuming they list on NASDAQ, that will equate to like a significant portion of the IPO float, right? So we're looking at just from if you include the S&P 500 for SpaceX, up to like $20 billion in buying of that $75 billion. The benefit is that the S&P 500 wouldn't add for maybe 6 months, but Anthropic would be the same thing. We're talking about 25% of the float that could be bought up by these passive indices in the first 6 months.
James, this is the S&P 500 is the big one, and that decision isn't out yet. When are we expecting a decision from the S&P 500, and what odds do we currently have that they are going to vote to fast track?
Yeah, I mean, the odds were probably 75, 80% if you talk to Rob Duboff, who is our ESG. And, you know, most people hear ESG and they don't realize that includes the G in governance. And that's where a lot of this comes down to, and we pay attention to indices. But the date we're watching is June 8th. So we should know by June 8th that the S&P is going to do this. Russell already did it just recently last week. NASDAQ did it weeks before. These consultations are outstanding. But our expectation and my expectation is that the S&P is going to follow suit.
All right, well, June 8th, that means we don't have too much longer to wait for that decision. James Seyffert of Bloomberg Intelligence, as well as Anthony Hughes with Bloomberg News. Really appreciate your insight and your reporting here. We'll be back in a moment. This is ETF IQ on Bloomberg.
I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are swinging between gains and losses after reports that Iran will stop exchanging messages with the United States, casting doubt on a ceasefire renewal. Oil is surging on the news, with Brent crude around $97 a barrel, while strength in the energy and tech sectors help keep the broader market afloat. Helping on that front, software shares are leading the tech sector higher, with NVIDIA, ServiceNow, and Adobe all moving higher after NVIDIA CEO Jensen Huang downplayed concerns about AI disruption. On the other hand, Intel and AMD are both lower after NVIDIA unveiled a new AI-focused PC chip, taking aim at Intel's long-time dominance of the PC market. And finally, in deals news, MGM Resorts is advancing after billionaire media mogul Barry Diller made an offer for the portion of the company he doesn't already own. Those are your midday movers. I'm Nora Melinda.
And meanwhile, we have another headline following news that Anthropic has confidentially filed its draft S-1 to the SEC for an IPO. We're now learning that Salesforce's Anthropic investment is valued at about $5 billion. That is according to Bloomberg reporting. Again, we're going to follow this story very closely here on Bloomberg Television. But here on ETF IQ, it's time to take a look at the Bloomberg Intelligence Traffic Light System, which ranks ETFs by risk levels. Green light, as you might imagine, means low risk. Yellow light means moderate risk. And red light means high risk. Eric, what are we looking at today?
Today, we have a very high-risk ETF.
Let's go.
SOXS, which is the inverse triple leverage semis. Okay, this thing is a live wire, okay? It can go up a lot, like it goes up, 15%, 20% some days, right? But it's down 90% year to date. Anything that has this heavy of leverage, we automatically go red, right? Because of the way the daily resetting works, and also just you can lose a lot quickly. But here's the thing about this ETF.
Yeah.
If you look at all the tech sector ETFs in the past couple months, this is the fourth biggest flow-in getter. You'd be like, well, why would something down so much get in the flows, whereas the triple leverage long has seen outflows? It's because this crowd, they love to play mean reversion day to day. It's a very dangerous game, but they love to go to the one that's just been beat up. And that's why this thing is taking in money, even though it's down 90% year to date.
I feel like we see that sort of trend often when it comes to these extremely leveraged exposure plays here, because, we've seen this when it comes to long duration treasuries before. You're losing so much money in this fund and still money keeps pouring in.
It's like a siren song. It's so tempting because if you get it right, you hit the jackpot, because there is a lot of people who think there's too much air in this trade. And when it pops, SOXS will be like 777 in Vegas, right? It's going to go up big time. And so there's a lot of people betting on that, as well as going back and forth between them. But some people don't realize how popular these are. SOXS trades, if it were a stock, it would be in the top 1% of equity trading. It is very popular.
Very popular. Red light, though. Thank you, Eric. And you can, of course, look at the traffic light system on your terminal at BI ETF Go. Now, coming up next, we're going to speak to Corey Hoffstein of Newfound Research to drill down into one of his return-stacked ETFs. That conversation coming up next. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld. It's time for today's drill down where we focus on one ETF. Eric, what do you got?
Katie, today we're looking at a very interesting product, RSST, the return stacked U.S. and managed futures ETF. Anybody out there know what portable alpha is in the institutional world? This is sort of democratizing portable alpha. What does that mean? It means you basically get 200%. You get 100% stocks, right, in like an S&P 500, but you also take the money that you get from buying futures in a managed futures strategy and invest them in the stocks. So you get managed futures stacked on top of the S&P. That's the idea here, hence return stacked. Fee is 100 basis points, about 99. It came out a couple of years ago. 473 million, pretty good for what is kind of like a hedge fund or institutional strategy. Let's look at the holdings of this. As I mentioned earlier, when you buy the managed futures, when you get the futures from that strategy, you basically get collateral and use the collateral to buy the S&P 500, SPYM. So this manager here is very well aware this is the cheapest S&P 500. And then here you can see all of the futures. This is going to be a non-correlated inflation fighting strategy that fits on top. And this way you kind of get your cake and eat it too. Let's look at the performance of this ETF. I know I put SPY in here. I put AQR's managed future and another managed future. So you can see that it's about the same as the S&P, but it's beating the managed futures because of that. There are some areas, like in the recent year, it's done better than both, and that's going to really matter. But you can see here, that's why people like it. You get that beta in there on top of the alternative strategy, Katie.
Eric, thank you. Joining us to talk about this ETF, I'm pleased to say, is Corey Hoffstein. He is CEO and CIO over at Newfound Research. Corey, great to have you with us. So to the layperson, this is pretty complicated stuff, but you take a look at a chart of your total assets. This ETF has really grown steadily since you launched it in September 2023 or so. So how do you explain this? You know, how do you socialize this idea and really make some of the people that you're trying to pitch to understand this concept when, you know, you think about the S&P 500, it's a pretty easy sell.
Thank you for having me, guys. And as you said, this is a strategy that we do have to educate people about. But when we look at what we're doing, it's really, as Eric mentioned, nothing novel. This idea of portable alpha has been around in the institutional space going back to the 1980s. And really, what's happening in the world of ETFs is we can bring it downstream, package this idea up in an ETF, and make it available to the wealth and retail channel. So that's really exciting for us. We call it return stacking rather than portable alpha because we hope it makes clear what we're trying to do. We're trying to stack the returns of a managed future strategy on top of the S&P 500. And that's really critical for a lot of investors because so many investors are comfortable with the S&P 500. They don't want to give up those returns. So the idea of adding a strategy like managed futures, no matter how good the historical returns look from a total return perspective or a diversification perspective, can be really hard to stick with when you have this rampant bull market. By return stacking, we can try to sort of have our cake and eat it too. We can keep that equity beta and then add that diversifying return stream on top, keep it along for the ride. So hopefully that it's there in the portfolios for years like 2008 or 2022 when you need it most.
Yeah, no, this is really interesting because advisors have traditionally not bought any alts in the ETF wrapper. This is a way to get them without having to give up their S&P. My question on the managed futures part of it, we know what the S&P does. How does that work? How much are you short versus long? How much beta do you have in there? Is it more like a completely true hedge fund, or is there a little more beta filler than maybe something that an institution might use?
Yeah, so managed futures is a hedge fund strategy that goes back to the 1970s. Predominantly uses trend following, right? So it's going to look at things that are going up and try to take long exposure to take advantage of persistent trends. And similarly, things that are going down, it's going to try to short. And it's going to trade futures markets globally in things like equities, bonds, currencies, and commodities. So you get a nice diversified amount of exposure that's very dynamic over time. So the question of, do you have beta in there? Well, the answer is when equity markets are going up, you can add some extra equity beta. When equity markets are going down, though, you can be short. Right now, if you look at the portfolio, a lot of our return is being driven by exposure to metals and commodities, complementing the equity beta in a very diversified way. But it is a very dynamic portfolio. It's very adaptive, and that's what's made it, as the hedge fund strategy, so resilient for so many decades.
And Corey, as we mentioned, I mean, you've had a lot of success with accumulating AUM here when it comes to your suite of return stacking ETFs. When I take a look at your prediction for the category overall, you've penciled in $50 billion by 2030. Talk to us about what gets us there over the next 4 years. How does this category grow to that sort of threshold?
Yeah, look, I remember my first meeting with some of the people who brought defined outcome ETFs to market back in 2019, 2018. And a light bulb really went off for me there saying, okay, the ETF is now able to bring this other product structure to market in a way that advisors can allocate it to it in their portfolio. I look at return stacking and the broader portable alpha ecosystem being the same. The ecosystem for what can be brought into an ETF wrapper has changed and evolved over time. We can now make these diversifying assets or strategies much more palatable by combining them with the beta. We've seen Morningstar recently introduce a whole new category for this style of product. They call it multi-asset overlay that had never existed before. There's probably between mutual funds and ETFs close to 10 billion in assets already. And I think what you're seeing as you look at the filings in the world of ETFs, more and more alternative managers are starting to bring product to market just like this. After we launched RSST, we've seen AQR bring mutual funds to market, Man Group bring an ETF to market, JPMorgan just launched a similar ETF. It's my view that this is the easiest way to get investors to add those diversifiers to their portfolio without having to sacrifice the core betas that they know and love.
Yeah, so it's interesting looking at your lineup. I mean, I think stocks and a hedge fund strategy is the obvious one. You also have bonds and managed futures, and then you have like bonds and merger arb. You've even got U.S. stocks and then gold, Bitcoin. Where else can you take this? Like, how many possibilities are there, and do you plan to launch more?
Yeah, I mean, so we have launched 8 ETFs over the last 3 years. We pretty much have brought a new ETF to market every 5 to 6 months, and I would expect us to continue. And it's a question of, are we changing sort of the base? Are we changing the nature of the stocks or the bonds, which to date have been very passive? Or are we adding new hedge fund strategies? Again, the reality is with some innovations that have occurred both in the market-making ecosystem as well as in the regulatory environment with the new 18F4 rule, we have a tremendous amount of flexibility as to what we can bring to market. Now, whether it's prudent to bring everything to market is another question. We always want to make sure there's sufficient demand. But even when you talk about something as simple as just commodities, which when I entered the industry back in the 2000s were very, very popular as a portfolio diversifier, but now show up almost nowhere, well, it may be a lot easier for investors to add something like commodities on top of their portfolio if they simply stack it on top rather than have to sell stocks and bonds to make room. And so we're looking towards all sorts of hedge fund strategies and even just more passive diversifying asset classes to see what can be put into the ETF wrapper.
All right, Corey, that's a good place to leave it. Wonderful to have some time with you. That is Corey Hoffstein of Newfound Research. And you can read all about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. That is Bloomberg.com/ETF IQ newsletter. Now, coming up next on ETF IQ, the television show, we're going to speak to Paisley Nardini of Simplify Asset Management about how ETFs are making room for institutional investors. That conversation next. This is ETF IQ on Bloomberg.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, U.S. stocks are struggling for direction after reports that Iran will stop exchanging messages with the U.S., raising fresh questions about a ceasefire renewal. Oil is surging on the news with Brent crude back around $97 a barrel, while gains in energy and tech are helping support the broader market and keep it afloat. In tech, software shares are leading gains with NVIDIA, ServiceNow, and Adobe advancing after NVIDIA CEO Jensen Huang downplayed concerns about AI disruption. Elsewhere, IBM is climbing after a 6-month-old video of President Trump praising the company's CEO resurfaced online, underscoring the speculative enthusiasm that's been driving parts of the market. And finally, Optimum Communications is rallying after announcing a series of transactions aimed at strengthening its balance sheet ahead of expected talks with creditors. Analysts say the move could help improve investor sentiment. Those are your midday movers. I'm Nora Melinda.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Now let's go through the ETF life cycle from its initial filing to its final farewell. We start with the filings. Amplify ETFs has submitted paperwork for 6 new actively managed thematic funds. They cover nuclear, semiconductors, quantum, defense tech, space, and Asia memory stocks. Now they're going to be powered by indices from Bloomberg Intelligence. Step 2 is the launch. There were 2 new levered ETFs that were launched on May 21st, both tied to AST Space Mobile. One was from Defiance and one was from T-Rex. And for some, the final stage is farewell. Bond Blocks has liquidated a bunch of products from a suite of sector-focused high-yield bond ETFs. Joining us now is Paisley Nardini. She is head of multi-asset solutions over at Simplify Asset Management. Paisley, it's great to have you with us. I want to start with a line from your notes because you write that allocators who built for the post-GFC regime are exposed and that the last 4 years have been a proof point that portfolio construction is ripe for refining. Talk to us a little bit about what you mean there and what refinement actually looks like.
Yeah, Katie, Eric, thanks for having me. Happy to be here. That comment really drives to this thesis that I'm looking at the markets, and I really think we're looking at this era of false diversification. And to break that down, what I mean is, as we look under the hood at what portfolios actually own, whether they're in passive or active solutions, I think investors have really just been idle. They've been complacent with these portfolios that they maybe built for their clients a decade or 2 decades ago. And as we've seen in this kind of post-COVID environment with higher sticky inflation, secular growth declining, there's a lot of external forces at play that are kind of pressuring portfolios. And I mean, even year to date, although we started with a little bit of breadth in the large cap market, in the last 2 to 3 months, we've really seen that narrow considerably. So most of the risks that are driving portfolios are equities, and within equities, as we know, they're concentrated in a few names. And so as we kind of take that out into more of like a 30,000-foot view, what that means is a lot of these portfolios are really ripe for refinement, for enhancement. And I think a lot of what advisors are hearing about is, hey, you need to rehaul your portfolio. You need to take everything out and start from scratch. And ultimately at Simplify, what we work with our clients on is how to kind of make some tweaks at the margin and just being more cognizant of what you hold within your portfolios, knowing that there's a lot of concentration risk.
Yeah, I think it is very difficult to get advisors to focus on protection or diversification when the markets are so good. That is a point totally taken. I guess, my question is they'd probably come back and say, well, I have bonds for that. I have a 40% bond allocation. Is that enough, do you think, or you think it really is these mega caps are enough to destroy everything?
I want to preface by saying I'm not insinuating there should be an overhaul and all bonds go out of the portfolio, but if the core objective of having bonds alongside stocks and equities within your portfolio is to act as that ballast or that hedge, it's a wake-up call. Since 2022, stocks and bonds have had positive correlation, meaning they move together. And just year to date even, had about a 0.5 correlation between broad U.S. stock market and core bonds. So what this tells us is bonds are in the portfolio more so for yield or for income today. We actually think there's maybe more opportunistic ways to source higher levels of yield beyond traditional bonds. But that aside, bonds are not really cutting it for that diversification benefit. And again, this goes back to that comment I made earlier, this narrative of false diversification in the marketplace. And so that's why we really think it's so important to think about additional ways to add low correlation to the portfolio. I'm glad you guys had Corey Hoffstein on even just before this session, because what they're doing in this return stacking element is one component of how you can enhance portfolios. Simplify has a solution in that as well. But it's really looking for true diversification, which goes beyond just the traditional labels of stocks and bonds.
Well, when we talk about that correlation, certainly you're not alone in calling out that bonds have been an unreliable hedge. You've seen, some folks turn to buffer ETFs as a way to replace that. You've seen more folks go into alternative strategies, for example, to get that sort of haven diversification. I wonder, what you think is sort of the haven asset in this sort of environment. What sort of strategies kind of replace the role that bonds have classically played?
Yeah, so I may be biased, but I'll give you some data to back this up. Managed futures are, in my opinion, one of the strongest ways to express true diversification in a portfolio. Simplify has several iterations of trend following and managed futures in our shelf that have proven out over the last several years to act as that ballast in times of need, whether it was 2022, and I would say more recently, just the first quarter of this year and what's now moved into the second quarter, trend following was one of the best performing asset classes or strategies in the market. I think the other benefit too that a lot of allocators maybe don't see at the surface is because you're investing in futures contracts within a managed futures strategy, all of those futures have to be backed by cash collateral. What's the benefit of that? You get the yield from the cash collateral or treasury bills in addition to the diversification. So you start to think about if I'm funding a managed future strategy from bonds, I don't have to completely sacrifice on the income, and I'm getting significantly stronger diversification power than what bonds have provided over the last few years. So trend following or managed futures, we think, is one of the most impactful ways to enhance diversification. And historically, just at the index level, the SocGen CTA index had about a zero correlation to a traditional 60-40 portfolio over a very long tested period of time. So that consistent low diversification is why we think it deserves a place in a portfolio.
So I just want to talk about Simplify. To me, you guys are the closest thing to a hedge fund manager, like a true hedge fund manager in the ETF space. You now have $14 billion, and you've been able to sort of sell these more complicated strategies to advisors. But anybody listening to you talk knows that you speak very fluent institutionalese, if I may use that term. But basically, institutions, though, have been so reticent to use ETFs. You're the one firm who seemed to have gotten some leeway there. How is that going? We get why this would be good for advisors. What about an institution using an ETF for these strategies versus going to another route like a separate account?
I've spent most of my career working and supporting institutional asset owners and asset allocators, and this has been a slow migration. And I think with the proliferation of these more hedge fund strategies in ETFs that we've seen really boom over the last 5 years has been that catalyst to finally get institutional asset owners to pay attention to the space. Many of them within their broader, IPS statements in their portfolios have a risk mitigation sleeve, a defensive strategy sleeve, which has traditionally housed these liquid alts or hedge fund type strategies. And so now that they can access these in a daily liquid low cost ETF, it just gives these institutional asset owners way more leeway and flexibility to make tactical trades to free up capital, whether it be for other parts of the portfolio. Private markets are obviously a big component of that. And so not only is it allowing them to lower their fee structure at the portfolio level, which is really important for their boards, but it also just gives them more flexibility. And I think the other point that's really helpful, especially in the public pension space, is the access point.
Right.
So some of these strategies really require very sophisticated tools and ISDA agreements with banks directly. That provides a huge headache for a lot of these public pensions. So if we can deliver it to them in an ETF, it really makes their life easier.
All right, Paisley, we have to leave it there. Hope to have you back soon. That is Paisley Nardini of Simplify Asset Management. Now, coming up, it's time for an IQ test where Joel Weber puts our ETF knowledge to the test. Here's a sneak peek at one of the questions. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld along with Eric Balchunas. Scarlet Fu is on assignment. So it's just Eric and I for today's IQ test where Bloomberg's Joel Weber is going to see whether we really know our stuff when it comes to ETFs. Joel co-hosts the Trillions podcast with Eric. He's also the head of games over at Bloomberg. So Joel, put us to the test.
Are you ready to be tormented?
No.
Okay. I like during that tease, like you got a sneak peek and both of you admitted that you didn't know the answer. So
doesn't feel good.
What is the average expense ratio in basis points for a thematic ETF? Is it A, 30, B, 40, C, 50, or D, 60? Katie?
I'm going to say 40.
Just throw it out there.
Yeah, why
We're
not?
kind of in the middle.
Yeah.
I'm going to go 50.
50.
Oh.
It is D, 60.
Oh,
yeah.
brutal. That's really high.
Make your money. All right.
That's why they launched so many of them.
That makes sense.
Okay, so speaking of
It's a
which,
Vanguard-free zone.
I like this idea of like thematic, so I'm going to give you a tease. This is a thematic themed ETF IQ quiz.
Ooh.
Next question. Which issuer ranks number 2 in thematic ETF assets under management after BlackRock? A, Murray, B, State Street, C, Van Eck, D, First Trust.
Oh my God. I'm going to say Van Eck. Why not?
Okay.
I want to say Murray, which is Global X, but First Trust is it could be First Trust, but I got to go Global X. It should be Global X.
Okay, he saved himself there.
Okay,
it is A. Yeah, okay. Okay, number 3.
I have to get this right. I can't goose egg this.
It's a rough day. Happy Monday.
It doesn't feel good.
Which thematic ETF has attracted the largest inflows so far this year? Is it A, PAVE, B, Shield, C, Bay, or D, Grid?
Eric, why don't you go first?
Okay.
Well, I know this, I think. I'm 85% that it's Grid D.
Okay. Katie?
Yeah, I feel like I can't do what Eric did, so I'm going to say B.
Okay. Why don't you feel like you can do what he did?
Because, then I'm just blatantly copying him, which, I'd be comfortable with.
this
But
case,
we're on
You're down
camera.
0-2. Like,
It's
follow
okay.
his lead?
I'll take the goose egg.
Okay.
I'm going to say B.
Okay, it is D.
Yeah, all
He
right.
got that one right. Yeah.
All right.
All right, well, there you go. That was a fun little round. Sorry,
was fun.
I'm really sorry for you, Katie. If you like playing games, you can obviously play Quiz Go on the terminal where you can get some more quizzes, or Bloomberg.com/pointed, where we have another news quiz where you can play with some weightings, leverages, and have some more fun.
And it is a lot of fun, and it is fun to incorporate leverage as well. Joel Weber, thank you so much. He, of course, is our head of games over at Bloomberg. And that does it for Bloomberg ETF IQ, the television show. We'll be back next week. I'm Katie Greifeld along with Eric Balchunas, and this is Bloomberg.